It is Sunday, December 21st, and it is the beginning of the afternoon. We've got football games going on, and we've got a stock market that had a couple difficult days for 2, 3 days, and then it started to rally kind of midweek. Overall, we ended the week, I think, up just slightly. And we'll see if the Santa Claus rally is going to show up here in late 2025 to give us a nice rally to end the year. We've got kind of a shortened week of trading this coming week. We've got Monday, Tuesday, full days of trading, and then Wednesday, it's going to be a half day. Wednesday is Christmas Eve. So the market will close a little early. And then on Thursday, it's going to be closed for Christmas. But then we come back on Friday for a full day of trading. We'll come back the following week and have 3 days of trading and finish off 2025. We'll see if we start to rally and see Santa Claus come to town and see us see some rally in stocks really show up. I wanted to thank our newest member of my channel, Wisdom is Truth 6886. Thank you so much for becoming a member. I appreciate it. Please get me your email address. I will put my email in the chat, and you can email me so I can get you all the perks that come to you that you get as a member. Be sure to put in your YouTube name so I can link it to your email address, because I do provide, for example, you're going to get access to the tools that I use that you're going to see on the live stream. And you're an advanced investor member, so you get access to the tools. And I do that by giving you access to a shared folder with that level of members. I'm also going to invite you to member calls, invite you to the Discord, and get you all set up. Thanks so much for becoming a member. And thanks to all members currently that are a part of the community. I appreciate it and hope that I can really bring a lot of value to you as you continue to be an individual investor figuring out how to beat this stock market. Looks like Magical Self is on. How are you, sir? You got it. Let's take a look at, we're going to look at TYL, and we're going to look at Regeneron. And glad to do that. Regeneron is a stock that I've been buying into, so I've got a lot to say there. Tyler Tech, I'm not familiar with that one, but I look forward to taking a look at it. We can take a look at that one second, if you wouldn't mind. We'll look at Regeneron first, because I know I've got kind of something to show straight out of the gate. So we'll go with that one. Happy Sunday, Herdo. Very good to see you. Thanks for joining. I hope you're having a nice Sunday. Hope you're setting up for this week's trades. So far, the market, I think the sell-off we saw at the end of the week prior, and saw that really difficult Friday sell-off. And then the first 2 days of this past week where we had negative days, that was very productive in my mind, because when you have a nice sell-off like this, it sells off some stocks that maybe were just priced too high, gives us a better entry point. We've seen some good tech stocks sell off, and that's a good thing. It makes them more investable. The AI trade really was losing steam for about a month, and now, the prices are better. So that's a good thing. When we look at what's going to work for 2026, I think having lower stock prices enables us to take positions that are going to work in 2026 with the very well-known stocks, the NVIDIAs and so forth. Of course, the other stocks that are going to do great are going to be maybe in sectors that didn't do as well as technology in 2025, 2024, 2023. And they have a lot of room to go higher. And that's why I think those are going to be really good winners. So I like to find a good balance of stocks that are small, unknown, and buy those. Really monitor them closely. And then once they start to work, really bet big. And I like to hold some very well-known stocks like Google, Meta, and those tend to be really solid winners. I tend to think those are like the the basis of my portfolio. I have a lot of trust in those stocks. I have a lot of positive sentiment around those companies, and I hold them long term. So it's a good combination of the two. And looks like Benton is on. Good to see you again. Thanks for joining. And I'm gonna try to stream for a while today. We've got football games that just finished. We got football games that are gonna start. That's all good. I like watching football, but I like trading stocks more because when I trade stocks, I'm actually in the game. I'm in the game to make some money. I'm in the game to grow my wealth, but I do enjoy football. I enjoy it watching it with family, especially, and friends. Rooting for a team and look forward to the Super Bowl. Although we're like probably a month and a half from that event, but it's always a good time. Okay, so we've got two stocks on the list to review, and I've got some stock ideas as well. But let's go ahead and get rolling with the list of stocks that was requested, and then I'll come back to the list that I had in mind. So the first one I'm going to cover is Regeneron. Now we talked about, or I should say I talked about how technology's really done great. Now Regeneron is a biotech company. It's a pretty good sized company, $79 billion in market cap. So it's not a small cap. Forward P looks pretty sensible at 17, pays a small dividend. And if we look at the last month, you see that we've had this stock begin to rise. And I reviewed Regeneron on a best and worst video that I created in the last 30 days. And this one really stood tall. It stood on its fundamentals and it looked really good. Now, what looked good about Regeneron? So let's look at its recent history and then more importantly, its forecast. So it's a pretty good sized company. Its revenue is 14.2 billion. So that's pretty big. They're growing 8% if we look at the last full year. But we're getting close to the end of 2025. And you see that the stock had a difficult first quarter in 25, somewhat of a slower quarter in Q2 versus the previous year, and then kind of a flat most recent quarter. So this stock or this company has had a year where things are not going their way completely. When we look at the trailing 12 months, it tells us that, yeah, the revenue's been slowing down. Is that going to be the case going forward? Well, we just saw everything through the rear view mirror, what has happened in the past, which is important just to understand what's been going on. Let's start looking through the windshield. What's going to happen going forward? We've got 23 analysts putting in their research on Regeneron, and they think it's discounted by 3.62%. I like the way Stock Analysis puts together this page, and I like it a lot because they're bringing together the financial forecast of Regeneron. They do this for every stock that's publicly traded. And this is what I'm focused on. So if I look at the rearview mirror, yeah, the company has slowed down. But if I look through the windshield, revenue is going to start growing. And it's going to grow quite nicely in about a year and a half. And it's going to keep growing. Again, these growth numbers are not like NVIDIA level, like, oh, growing by 60%, but they're good growth. The profits are going to expand in a year and a half by 20%, bringing down their PE ratio to 14. So when I look through the windshield, look forward, I look at a forecast, that's looking really good. And that's the basis of my enthusiasm, my positive thinking about Regeneron, that, hey, this company does produce really good free cash flows. It's a very profitable company with very big margins in their business. And if they start to grow, this stock could really perform because when I buy a stock is really important. And you see that the stock had been beaten down. It's beginning to work. Had an opportunity here to jump in and then continue the rally higher. When we look at the 5 year, that really does show that the market was really positive on Regeneron, and then it went negative on it when it started to slow down. But Regeneron does have some products that are going to enable the growth going forward. So I think that Regeneron could retrace and come back to maybe $1,000 a share or higher. I've valued Regeneron using that whole research that I just shared with you, that body of research where what's going to happen in the future? How's it going to grow? What are the profitability? What's the profitability and the free cash flow of the company? And it leads me to this valuation here. I think the stock's discounted by 31% because its cash flows are very good. Its cash flows, based on my research, are worth 38% more than its current stock price. And if I look at its earnings per share using a PE of 18, the profits from the business are worth 14% more than the current stock price. Collectively, it's a 31% discount. The other thing I like is we're seeing that Regeneron, its stock price is beginning to go higher. And I'd really like, one of the things that could be the case is I find a company that's discounted, but it doesn't go any higher for a while. And what I'm seeing with this stock is the market really started to pick up the stock price, and then it had kind of a pullback, and now it's really rallying higher. So it gave me an opportunity to buy shares here, but I think it's going to go even higher. As mentioned, there's a 31% discount on the stock. And I think it's going to go back to maybe its all-time high because it got here to begin with. And healthcare, especially, is not a space where it got bid up. It's not like AI that everybody jumped into AI kind of blindly in some cases, like, hey, just buy it because it's been going up. It's probably going to keep going up. And I have to admit, some of those investors are right, but it's a little bit dangerous because it could stop working and then you're left with a really overpriced stock. In this case here, this stock got to a really high stock price of almost $1,200. And I think it could retrace and come back to at least 1,000. So I've been buying into Regeneron and think that, based on the valuation, it's a really good risk reward situation for me. So I've done the homework, the analysis, and that's there. So I'll try to update the repository evaluations that I share with investors, so you guys have access to this, because this one was done more recently, just a couple weeks ago, and that's Regeneron. It's looking good. Out of that video that I created and the research I did of best and worst biotech companies, Regeneron was one of the highlights. I think that there were two stocks that really looked good in that video. So that's Regeneron. Out of the gate, I think it was Magical Self. Good to see you. It's been a couple of streams since you've been on. It's good to see you again. So the other one you want to look at was Tyler Tech. I'm not familiar with Tyler Tech. So Tyler Technologies provides integrated software and technology management solutions for the public sector. It operates in two segments: enterprise software and platform technologies. The company offers platform and transformative technology solutions, including cybersecurity, threat detection, response, customized employee training, vulnerability testing, data and insights, and digital solutions, billing, presentation, merchant onboarding, collections, reconciliation, and disbursements. Okay, so they're really focused on public sector. So that's selling to government, and so it looks like they're selling to cities, counties. Those cities, counties are managing things like the deeds on real estate, that kind of thing, tax collecting, that kind of thing. So that's where they're at. So that's a pretty stable market. You think about, cities are going to continue to charge taxes based on properties, and I should say counties and local government. So I get the target market, the addressable market they're going after. Over the 1 year, this has been under some pressure. Over the 5 year, it has not performed very well. It has had a really nice run coming out of 2022. It really rose nicely from 300 to 600, so it doubled. But more recently, it's been selling off. Market cap 19.7 billion, so it's not a giant company. And forward P is 37.8. Now, that is an expensive PE. They need to be growing to have a PE that's that high. And analysts think it's discounted by 42%. So let's look through the rearview mirror. What's been happening in the past here? It's been growing, not setting any records. 9.5% growth in the last full year is very good growth. 23 wasn't very good, but other years looked really good. 21 was specifically a really good year. They may have acquired a business. Now, if we look at the quarterly, the growth looks pretty good. It's been pretty consistent at around 10%. So 10% growth's okay. It's not a big revenue company, 2.3 billion in revenue, and it's not a big market cap. So those two things look okay. Now, that high PE ratio, I wouldn't pay that PE ratio unless they have some really good growth ahead. Because I know there's other software companies where I can get that kind of growth on the top line. They're bigger companies and they have lower PEs. So why would I pay a higher PE for a company that has a limited addressable market where they only sell to public sector, local governments? Now, they have been growing their free cash flow. That looks good. And their gross margins are not as good as I would have hoped. Software companies could have gross margins up to 90%, very high gross margins. This one doesn't. It's probably because it's hosting a lot of the software it's providing to these local governments. And that costs money to host it, to run it, and so forth. So they do have profitability, consistent. That looks good. And the free cash flow margin is very good. 27% is very good, I would say. So consistent business growing at 10% with free cash flow of 27. I have plenty of software stocks to compare this one against. So we're going to do a valuation on this one. It'll be a good one to take a look at and take all the fundamentals and put them into a calculation. Now, analysts are pretty positive on this stock. 11 of them cover it. And they're going to continue to consistently grow. They are kind of a small company, by the way. Now, I'm going to match these guys up with a company that's similar to what they do, but they're not just focused on government. In that business, I'm going to say, let's match them up next to DocuSign. DocuSign, they provide software. A lot of people know them. They do signature capture software. If you've taken a home loan recently, you probably use DocuSign, because when you get a home loan, they make you sign like 100 documents. And that is not an exaggeration. They make you sign and sign and sign. Well, they're doing it now in a digital method, and they use DocuSign in most cases to do that. So DocuSign's a software company. They're growing about the same rate that we're seeing with Tyler Technology. So it's a good example just to see what a company that provides software is looking like, and see if Tyler Technology is discounted or priced at premium. So these guys, we're going to update the symbol. So discount rate, I'm going to leave it alone. I don't know them that well, but I haven't looked at their balance sheet. It could change. It could get a little riskier, but let's get into it for now. So you see that the market cap for DocuSign is 14 billion. The market cap for Tyler was above 18 billion. So right out of the gate, the cash flow for Tyler Technologies is not as high as DocuSign. So that's a first sign that maybe we're dealing with a little bit of an expensive stock. So the trailing 12 months free cash flow for Tyler Technologies was $618 million. All right. And it's growing at about 10%. So I'm going to say 9%. I always played a little safe, a little conservative. So we'll go with 9%. So the intrinsic value of the cash flows is 20.4 billion. Now, what kind of cash and debt do we have on that balance sheet? And we've got more cash than debt. That is good. They have 643.45 of debt. So the shares outstanding are not correct. Let me correct that. I like using these Google lookups, and then they update that at all times. So you can see that the stock is fairly priced if we compare the value of the cash flows versus its current stock price. Now let's take a look at the earnings per share. And I'm looking at the earnings per share for 2026. We're knocking on the door of 2026. And whenever we look at these numbers, even this number here, we're always looking forward. We're looking forward in time and saying, what is this business worth based on the next year and following years of cash flows or profitability? So for 2026, the earnings per share is supposed to be $12.69 per share. The PE ratio 24. Okay, I'll give it a PE ratio 24. It is growing. It is profitable. I was maybe thinking 18, but let's leave it at 24. And from 2026 going forward, they are supposed to expand their earnings per share by 14% and then 18%. So I'll go with a 12% growth rate. So when I look at the value of this business, it's a fairly priced stock. It's priced just 4% too high, which is close enough. It's pretty fairly priced. Now, Taylor Technology, it doesn't have a brand of its company that's going to attract a lot of investors, or investors will not notice this stock all that often, which is a concern. I wouldn't buy a stock of this type at fair price. It'd be another matter if, let's say, you're dealing with an NVIDIA or a Google and you're like, hey, I'd really like to own that great business, and I'm willing to pay fair price. This one here wouldn't. This one here would be a pass. I don't own the stock. It would be a sell, because there are terrific software stocks out there available. Adobe beginning to work well, really highly discounted. Salesforce discounted, and it's beginning to work. Intuit has been seeing a pullback, and Intuit's an awesome company, really, really solid business. It continues to grow. It's a big business. So those are the investments I'd rather make, and Tyler Technology would not be one of them. So thanks for asking about Taylor Technology. It is not going to make it into my portfolio, but I appreciate you asking. It's always good to see some stocks that I'd never touched before, just to see what it looks like. Sometimes we end up finding something that's super interesting. All right, so let me move on from here. I'm going to delete the homework here, but I'm going to wait until after the stream in case somebody has a question later. I can come back to it and answer that question. So I'll make myself a note to delete it after the stream. All right, so I think there's a question that came in. Let me address that question. What is the position size for Regeneron? So Regeneron is a pretty good size market cap, right? It's 78 billion, I believe, or 80 billion in market cap. So it's a known company. And I intend on having a position of maybe 1% of my portfolio. That's a good solid position. And if it continues to improve, like let's say the growth projections of the company continue to improve, I would increase maybe to 1.5%, 2%. But just for the next 3 months, if I can get it to a 1% of my portfolio, that would be good for me. And if you look at Google, that's like 13, 14% of my portfolio. Big name, very well known. And it's gotten from being a 9, 10% position to 13, 14 because the stock's gone up in price, which is great. So that's to kind of give you a sense of, okay, what's the biggest stock in my portfolio and how big would this one be? So this one could get to 1% of my portfolio, to answer that question. All right. So what is the value of Intuit? I'm glad you asked. And since you're asking about Intuit, let's take a tour of the Intuit business. So Intuit's a 17% discount stock. Its cash flows are very good. Discount of 24%. Earnings per share, it's fairly priced, but I put more weight in the cash flow method. If you look at the blend, I take 2/3 of this valuation when I blend it, and it's 17% discount. When we talk about Intuit, it's a terrific business. Intuit has its TurboTax business, and it has its QuickBooks business, and it has its I think it's called Email Monkey business, and it's also doing some like personal finance now, and it makes a lot of sense. Now, when we look at the Intuit business, like where tax season is going to begin in about a month and a half, really. I don't think anybody does their taxes, or few people do their taxes early January. Usually wait for your documents to get to you, and then boom, toward the end of January, early February, a lot of people start doing their taxes, and they use TurboTax. So that volume is coming. Now, the growth in Intuit, look at this growth. Green, 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 always green. So they have a way of growing their business, growing that top line. When we look at the quarterly, it's still green. So the market didn't like that its earnings per share, I think, did take a little bit of a dip here. And it didn't like that. So it sold off the stock. Now, I've been aware of Intuit for a long time, but it's one of those really desirable businesses in my book. And you see how it's grown its free cash flows. That's part of what I like. Look at these gross margins, 80%. Remember when I looked at Tyler Technologies, its gross margins were 45%. So this one has just so much more room to be profitable. It continues to grow its business, and it's growing because it can advertise, and it has a big addressable market, which is everybody in the United States, all the businesses, small businesses in the United States for their QuickBooks business. So all those things look good. Its profitability looks really good. Free cash flows look superb at 33%. So these are just really good numbers. Now, when we look at a forecast of Intuit, they have a fiscal year that ends July 31st. So we're currently in this fiscal year. And this year, they're supposed to grow 14.8, 12.4, 13, 13.3. So these growth rates are higher than Tyler Technologies, and they're bigger, much bigger. They are like 10 times bigger than Tyler Technologies with $21.6 billion in revenue, growing to 24, 27, 31. So these guys are big. And the earnings per share will grow as well, expanding nicely, bringing down their PE ratio. But, Intuit's a little bit like Visa or, really highly respected companies. That's where I put Intuit. I really like the company. I've known of them forever, and I've been a customer of TurboTax for 30 plus years. And I could tell you that their software is good. I do my taxes on it every year. So this one here just looks really good. Now, my conviction on Intuit is really high because I'm aware of their business. I love their profitability. The market did me a big favor and lowered the price so I could accumulate Intuit stock while the price is low. And you see that these guys had a pretty good pullback here from 2021. A lot of stocks did sell off in 22, especially software stocks, and it began to rise nicely. And I took advantage of that sell-off. I made plenty of money, Meta, Netflix, a bunch of stocks, Robinhood, Coinbase. I mean, they can go down the list of 15, 20 stocks that I made really good money on, but I never bought into it. More recently, the market sold this stock off, and that's what opened the door. I think the valuation's terrific. I've picked up shares. I think it's going to go higher. I think this stock is going to go back to 800. It's going to keep going higher. It's worth more. And that's my research on Intuit. It looks like a good business. And I think software is good looking space right now. Let me show you the heat map. So for the one, I'm going to show you the 1 month. And so for the 1 month, this is the heat map here for 1 month. And NVIDIA is pretty much even. So is Broadcom. AMD is down. Micron is up. So these stocks have been obviously the leaders of the pack. And Microsoft's been down. But you're seeing that some of these stocks are beginning to show signs of good appreciation. And Adobe's up almost 10%. CRM's up 11%. Intuit's up 3.3%. And that's showing me that, hey, it may be that this area is receiving more investment from investors that are seeing these fundamentals and liking what they see. They're also moving money out of some of these really good winners into this space. So that's a theory. And if it continues to grow, what I like about it is, let's take a look at the 1 year. We are starting with stock prices that are low. This sector in a way has been discounted for a year, 2 years, and while other stocks have been really flourishing. Now it's great that these have flourished. Great. I'll take all my gains on Google. No, you're not going to get an argument out of me. Thank you, stock market. I'll take all my gains on Uber. But it's not about, hey, I'll just buy more Google. It was a really good stock for me. No, I'm looking forward. I'm looking through the windshield saying, where are the best investments? Well, if you're going to give me a discounted price on these stocks, I will be a participant in that market. So that's what I'm looking at when I look at these stocks. You see that everything's green when I go to 3 year, right? And that doesn't really give me a good example to work with, but I think you could see it in the 1 year. This is why I'm excited about this space and I'm excited about software stocks. I think I'm going to make some good money in 2026 in the software space. Looks like we hit a vein of value, a vein of valuable discussion. Because I'm seeing you investors, you guys are like, hey, man, let's talk about more software companies. Let's talk about service now. Because if we got good discounted stocks that are going to make us some money, let's do some more homework. A service now for a while was just rocking and rolling. Look at that appreciation in the stock. Now, ServiceNow is betting that they're going to capture a lot of the AI services. Businesses will use the ServiceNow platform to create agentic AI that can do tasks that a person was doing or has been doing for a long time. And these tend to be administrative, kind of repetitive tasks that are maybe could be done by an agentic AI uh, process or agent. Good idea. So they're really betting big. Now, recently, the stock market has said, "Well, we don't really believe in you, service now," which is kind of weird because all we hear is that AI is going to do so many things for us. There's going to be massive job losses due to AI and that kind of thing. So this may be an opportunity because ServiceNow, along with Salesforce, has been kind of sold off by the market. They don't believe that their agentic AI platforms are going to be all that important. But let's take a closer look. I haven't taken a close look at ServiceNow in a little while. $161 billion in market cap. Forward P is expensive. I know that they're growing. We'll see how fast they're growing. Discounted by 43%. That looks like a nice discount. All right, so let's look through the rear view mirror. What's it been doing over the last couple of years? Growth of 22%. That's really good. Now, the rule of 40, you add revenue growth plus your profitability. If you get above 40, it's a good investment. Profit is 13, so it's not above 40. It's below 40. So from that perspective, it's not looking like an incredible opportunity. Maybe it's still an opportunity, but maybe not as great as some others. Now that was the rear view mirror. Let's keep looking through the rear view mirror, but look at the quarterly. Its growth is pretty consistent, 22%, and that looks pretty darn good. This is a pretty good sized company. This is not a small company, $12.6 billion in revenue. And it's good that we looked at Tyler Technology first because that was like 2.4 billion. So we're seeing kind of different examples. Intuit was 24 billion or so. This one is 12.6. So we're kind of seeing different size companies based on revenue. So let's take a look at the gross margins. Gross margins is 78%. Isn't that a nice looking number? 78%. Beautiful. Profit margin is 13.66. And free cash flow is really good at 31. So the profit margins for the gross margin for ServiceNow is comparable to Intuit, much higher than Tyler. So we got that information. It's looking like an interesting company. We see that the market has sold it off. Now let's look through that windshield and see the forecast looking forward. What is this business supposed to do? It's going to keep growing. We're in this year, fiscal year 2025. It has a normal calendar year schedule. And next year, 2026, it's going to grow by 18%, 18%, 16%. Those are good growth numbers. They will go from being a $13.3 billion company up to 21.6 3 years from now. That would be excellent growth. So those are solid numbers. And its profit's going to expand nicely. I will use this earnings per share on the valuation. I have a valuation of ServiceNow. Let's see if I have it up to date. ServiceNow is looking like a good stock, but always remember that we are buying in a market of stocks. It's like going to the grocery store. You get to the produce section and you look at, let's say you're looking for good tomatoes, and you've got different types and different quality levels. You pick out the ones that probably look the best and looks like those look best, and you pay the best price. Well, you have a good lot of software stocks. Some of them look fantastic, some of them not as fantastic. So let's update the numbers on ServiceNow, and I will start working on this. So I'm going to refer to the data we just covered on ServiceNow in a different screen so I can update this, because I haven't updated it since April. It's been a little too long. So its free cash flow in the trailing 12 months has been $3,960,000,000. Growing at 20%. It's the first year, so I'm going to grow that by, I think they were growing by 18%. And then it was going to grow by 18, 18, 16. So I'm going to grow by 17%. All right. And then we've got cash on the balance sheet of $5,410,000,000. Debt, $2.4 billion. That's the same number. So it looks like they have a really good balance sheet. That's very good. And that's a good sign of a real desirable business, is when they can profit so much and they can create so much cash flow that their balance sheet's in really good health. They have a lot of cash, very little debt. It's a very good sign. So this number looks suspect. Let's get that updated. And I should go through one of these days and just update all these formulas to just do a lookup, just to make sure we're seeing the right stock, number of shares outstanding. All right. So that number was suspect, and yeah, it was wrong. So the shares outstanding is updated. This stock, based on its cash flows, is priced about 4% too high. Now let's take a look at the earnings per share that's out there. And for 2026, the earnings per share would be $20.60. It's growing nicely. PE at 28 is fine. Let's go with 25 just to be conservative. And then that number is supposed to grow by 20%, then 10%. So grow by 15%. So that's looking like, why does that look a little too good? Yeah, so, sorry. Yeah, no, that's correct. So am I seeing this right? I'm going to hit my refresh. So the forward PE that we're seeing on ServiceNow is 7.5. That's really low. But on the overview, forward PE of 40. What am I getting wrong here? So this is annual. Okay. So let's take a look at their website. Let's see if we can get the actual earnings per share numbers, just to make sure I'm getting the right numbers, because those numbers are suspect. The stock analysis website is very good, but every once in a while, I just showed you an example. The numbers are like, wait, did it? Because it's that website aggregates all these numbers, and every once in a while, it just the data there was a little mistake here or there, and it's not correct. So if we're going to invest big dollars into a stock, let's go to the most credible data source, and that's the 10Q coming from ServiceNow. Now, this is what the company reported. There's no doubt these guys this is the right information. So looks like, let's see if this is big enough for you guys. Probably not. Let me make it a little bigger. All right, so we're there. Okay, so I'm going to look at the 9-month and see where we're landing on net income. So you see the net income here, $6.50 for the first 9 months. How did stock analysis get to $20 next year? So that isn't correct. So 650, and if I annualize that number, it's going to end up being like $8.70. So you see how I'm getting the real data here. Okay, $8.70. So all right, so that looks a little better there. And actually, that number was $8.70 based on its current projection. So I'm going to make that a little bit better because I expect that the company is going to grow by 18%. So I'm going to go with $8.95, PE of 25. So the earnings per share valuation looks really good. And that's always been the case for ServiceNow in the past when I reviewed it. And cash flows don't get us there. And let me double check the cash flows because I did get the cash flows from stock analysis. So they got the earnings per share wrong. Maybe they got the cash flow wrong. So we'll double check the cash flow. All right. So this is for 9 months, 2025, $3.2 billion for 9 months. And then they bought CapEx, $630 million. So that ends up being $2.6 billion for 9 months, 2.6 for 3/4 of the year. So if I annualize that number, divide by 3 times 4, 2.6 divided by 3 is going to be $870 million. Times 4 is going to be, and let me go to so 870. $3,480,000,000. So 3 billion. So that's kind of close. And let's take a look at now what I'm going to look at is I'm going to look at the quarterly for the cash flow and just make sense of the number. So here's the cash flow. That's making sense. Remember I said 870, boom, boom. They had a really good month here, really good month here. So the trailing 12 months could be higher. Okay, the free cash flow looks accurate that stock analysis is reporting. So that looks okay. So ServiceNow has a discount of 16%. Is that the best looking stock in the software lot? The answer is no. I think that stocks like Intuit's at 17, and I hold Intuit in a higher regard than ServiceNow. It's just it has a hardier business and more consistent business. Salesforce 37% discount. That looks terrific. And Adobe is 51% discounted, and that's a terrific discount. So you see that there's some really good discounts available within software. So ServiceNow is not one that I would want to add. I'm adding Salesforce. And when you add Salesforce, you're adding one of ServiceNow's main competitors. You know what? I could change this to 7.5 because the discount rates I'm using for a good quality company, these guys have more cash than debt. So actually, the discount's 22%. I still believe that Salesforce is a better investment for me. And ServiceNow looks very investable. If you really like ServiceNow, I think you can research the stock and probably arrive at a discount. So ServiceNow's looking pretty good, pretty darn good. So that looks good. All right. So that was ServiceNow. Handled that one. Let's take a look at where I'm at with the chat here. So that was Mark. And then Magical Self asking about Robinhood. Let's take a look at Robinhood. What's going on with Robinhood? Robinhood is still discounted based on my research. I think this is one of the stocks. It's just obviously it's no secret. Robinhood's just been killing it. It's been a really great performing stock, and they continue to make their company bigger and more valuable. They're doing prediction markets. They really nailed crypto. They have a credit card. They do a lot of things right. They're up 223%. What's going on for the last month? Up 13%. So this one here has just been up and onward and more valuable than a lot of its competitors that have been around for 40, 50 years, which is pretty incredible. And I own a lot of Robinhood. I've gotten there because the stock is up so much, and I'm not selling any shares. It's a terrific company. If I didn't own as much Robinhood as I own today, I'd be buying shares. So I think it's a business that's going to continue to dominate its market, continue to out innovate and outperform its competitors. So that is Robinhood. Thanks for asking, Magical Self. Michael Anthony, good to see you. So LW. So LW, what is LW? Lamb Weston Holdings. What do these guys do? Says, am I looking at the right one here? LW, right? LW. And these guys do production, distribution, marketing of frozen potato products. So food company. French fries, man, that is mission critical, right? We can't live without French fries. It's a must have. $6 billion company. So Michael Anthony, so it dropped on Friday, huh? Yeah, look at that. So why did the market drop it so much? Huh. Oh, so that's what was going on. The split. Got it. Yeah. Thanks for making me aware of that, because that's what's making the numbers not look right on stock analysis, right? Good to know. Yeah. Thanks for joining, Michael Anthony. You're one of the usual attendees. Thank you. If you want me to look at LW, buy a super chat, become a member. Love to look at it. And I don't think I posted it, but I think you guys come regularly. If you want me to look at a stock, buy a $5 super chat, and I will take a look at that stock. that you put on the chat. So I'm going to put my email address out there for any member that's signed up. Please email me and provide me your YouTube name that I could associate with your email. And then I'm going to give you access to the stuff that you're going to get for being a member. So, for example, we've had a couple members come in at advanced level, and then you get the level of videos you get to see is really driven from YouTube. So YouTube kind of controls that just based on the level you joined. And I've been creating a lot of videos for advanced members. I create videos for super investors, platinum investors that really focus on my portfolio. So if you wanted to see what I'm doing every week, I provide videos on what I'm doing. And I do a lot of deep dive videos. I release them first to advanced members, and then I release them publicly 30 days later. You get to join the conference calls that we have. You get access to my tools. You get access to Discord. So please email me if you joined. Love to get you your perks. Make sure that you get value from the channel. All right. So what are the stocks you guys want to take a look at? We've covered a lot of good ground. We've covered ServiceNow, Robinhood. We've covered Regeneron, Tyler Tech. It's going to be a good, forgot to check in on Mike. Mike, the dividend investor guy. Still watching the stream from yesterday. Yeah, thanks for tuning in. I appreciate it, Mike. And good luck this week. This week, I've been really trying to accumulate shares in a couple of stocks that I think are going to do great in 2026. And I'm taking money out of some stocks and concentrating that money into the stocks that I think are going to perform really well. And I don't own a lot of. So that's what I'm focused on doing for the remainder of 2025. I'm doing really well this year, way outperforming the S&P. And I want to set myself up to outperform the S&P again in 2026. So that's what my investing is going to be about this week. I'll share my trades to super investors as well as some of the trades to everybody on Discord. I think people tend to share what they're buying and selling on Discord, so I'll continue to do that as well. All right, so looking at the football game, I am now tuned into Steelers, Lions, and Steelers are leading 3-0. The game is being played in Detroit. I think the Lions must win. I think both teams must win. And they kind of control their destiny, whoever wins. If they lose, they're kind of at the mercy of other teams having to lose in order for them to make the playoffs. So we'll see. We'll see what happens. Looks like the Steelers are playing well. All right, so man, the Falcons can't win. Man, the Falcons never won the Super Bowl. They were close this year. That division is kind of easy division to operate in. So, all right. So since there's no more requests, what I thought we could take a peek at is we can look at the trending stocks on stock analysis. Most of these are interesting. So I thought I could kind of cherry pick some that look pretty interesting. Looks like Cora Weave came up on Michael Anthony's comment. We can look at that. We could also look at the others that are pretty big and amazing. Micron's had a terrific week. They really went up a lot. So we can look at that one. But before I do that, I'm going to take a quick break and I'm going to come back. It looks like it's 5:07 Eastern. And I'm going to take a 10-minute break. And I guess I'm going to round up and say that I'm going to be back at 5:20 Eastern. That'll be 2:20 Pacific. In the meantime, feel free to put, stocks you want me to look at. And I'll take a look at those when I come back. If you're a member, it's just comes with your membership, no matter what level that you're a member at. If you're not a member, buy a $5 super chat. I'd be happy to cover that stock. So like Adobe just came up, I'd be happy to cover it. Just buy a $5 super chat and we'll take care of that. But just hang tight. I will be back at 5:20 Eastern. I'm just going to take a quick break and I will be back with you guys shortly. Hey, everybody. Welcome back, or I should say, I am back. Thanks for holding tight. And looks like we do have Zeely join the stream. How you doing, Zeely? So let's talk about portfolios and how to diversify. So a couple of things that I'll mention on this area. And I'm going to open up my portfolio just to kind of make the point. To begin with, a couple of things that I'll put kind of on the table, so to speak. Your age, your risk tolerance, your risk preference. Are you young and want to take a lot of risks to get high rates of appreciation? Are you older and are like, I don't want to take any risk. I want to be very conservative. That's part of what's going to really influence the sectors you'll be invested in and what percentage. Another really important topic is which sectors and industries do you really understand well? And which sectors and industries you just really don't understand. And it's okay. It's like know what you're good at and know what things you just prefer not to do. That also will, I think, drive what you're going to own. I tend to own stocks that are in industries that I really have confidence in, I have good understanding on, have conviction on. And I tend to want to have an allocation into like some bonds that are super low risk because they're bonds. So I have an allocation of bonds, maybe 15 to 20% of my overall portfolio in cash and bonds. Once we get into stocks, I have a good allocation into communication services. I've invested in communication services for a long time. These businesses I really believe in. That's a pretty good amount of my capital going to them. That's probably going to be about, I would say 30% of my portfolio is in communication services. That's a big allocation. Consumer discretionary e-commerce, I feel the same way about. So I've really invested in that space. And that's probably in the neighborhood of 10, 15% of my portfolio. I'm beginning to build a position in Target. That's super tiny. I wouldn't talk about that a whole lot. Consumer staples has maybe about 3% of my portfolio. And I'm building that up because I think there will come a day when like the 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 bubble, or I think the enthusiasm about AI stocks will hit a wall. And I think we're going to have a pretty good correction in the next couple of years. And I want to have some staple stocks that are performing at a good level and paying it in dividends. And I want to kind of get good at it over the next 12 months. So I'm investing in some stocks there. Energy is part of my portfolio. So I would say that there's no like, I wouldn't say that there's like, you got to put 20% in tech and 20% in healthcare and 10% here. I think that that's kind of, it's not the right way to go about it. Go become good at understanding financial services and then invest in stocks and companies you really like Robinhood, Coinbase, and Citigroup. Go become really well informed on healthcare. And within healthcare, you can bet on growth companies like Genmab, Regeneron, United Therapeutics, Catalyst. Those are really good growth stocks. They do really well. So the types of sectors you invest in should be driven by What is your age? When do you want this capital back? Is it in 5 years or is it in 35 years? That's big difference there. If you have 35 years to work with, you can take big risk, and over time you're probably going to get ahead because you'll have some bad years, but you can have some great years. If you're looking at retiring in 5 years, you got to be very conservative. So that'll dictate it. And go into sectors that you really have grown your knowledge around and make it a point that, hey, I really want to understand technology, semiconductor, software, really want to understand healthcare, biotech, really want to understand financials like companies like Robinhood or banks, and kind of fill in your knowledge and only invest in things that you really understand. So that's kind of a long answer, but build your portfolio over time. Don't think that, hey, you started investing, you got to have your portfolio nailed within 30 days or 60 days. No, take logical steps forward and build a portfolio. You understand every stock in your portfolio. It's diversified across sectors and industries. And here's an example. I'm 57. I'm probably willing to take higher risks than the average 57-year-old, but I've taken risk in places that I've done my homework in, and places like technology, semiconductor, biotechnology. I've taken chances with like Reddit recently. That's working out nicely. And, I know where I want to take risk, where I think I understand those businesses, and I'm diversified. And so that's how my portfolio looks, to answer your question. And those are my thoughts on diversification. Diversification should be kind of an evolution to your portfolio. It shouldn't be hey, you can figure that out, in a day or a week. No, it should be continue to evolve with you. And you may have like changes in, your life. Like, hey, uh, you want to take bigger risk. You got some capital. You had a really good business year, got some extra capital, and you want to put it to work, and you want to have a good rate of appreciation. Great. Maybe you can look for some stocks that are going to be growing. Healthcare has some pretty good biotech stocks. Financials has really good growth stocks. And so does technology, still has some really good growth stocks. Okay, so let me so for all you guys, if you guys want me to look at a stock, put it in the chat. We'll take a look at it. And again, if you're not a member, just buy a $5 super chat and I will review it. And if you're not a member, or excuse me, if you are a member, just put it in the chat and I'll cover it. I wanted to look at some stocks that are on this list of the trending stocks and kind of pick out a couple that I wanted to kick around a little bit, if I may. So Nebius came up. It's come up a number of times. I wanted to update my research on it. You see that it was just killing it, just thriving, and it's had a pretty good pullback. It's pulled back quite a bit. Let me go over to Google here. So Nebius is located in the Netherlands. It's a neo cloud company. And neo cloud companies are smaller than the big cloud companies like AWS, Microsoft that has Azure, and then Google Cloud. So they're smaller. They really got going, right? Just really cranked up in rate of appreciation. But from its top, which happened October 10th to where we're at now, it's pulled back about 34%. And at the low, it had pulled back a whole 44%. So the market is a little nervous about Nebius and NeoCloud companies because the growth is there. But what I think the market is concerned about is If companies stop spending at the rate they're spending right now and to to buy these services that Nebius produces or CoreWeave or AWS, who's going to be the one left holding the bag? Nebius. And let's take a look at their financials and see how much debt they have and things like that. So Nebius is $22.5 billion in market cap. Taking a look at their website just real quick. Wow, that's a cool looking data center. Here they are. Okay. And I think I have a valuation on Nebius. I do not, so we can create one. And I have one on CoreWeave. So we could start there. Oops. And Hive is a similar company, but we'll start with Nebius. All right. And then we'll come back to Hive in a little bit. Okay, so let's update where we're at with Nebius on their financials. Let's take a quick tour together and then I'll update that valuation. So these guys, their stock's really moving. As I showed, they were up 400 some odd percent, down 40% or so. $22.5 billion market cap company. Its forward P not available. Current P ratio is a little high. Analysts think there's a big discount available. They are growing very fast, but you see, this is what is a little eerie about it is they were this big when they were just purely a crypto company. They did mining of Bitcoin and other coins, and they were making this level of revenue. And then they had a change in business, and that change, it took some time to ramp. But now that they're ramping, they are growing fast, but it's still a very small number. Looking at the quarterly, the number is getting bigger, but it's still a relatively low number based on their valuation. You're still paying, based on their valuation, you're paying like probably about 70 times revenue, which is a lot. So the growth is there. It's exciting, but are they really going to be worth their market cap? That is the long-term question that investors need to answer. They don't have any free cash flow because they're buying a lot of semiconductors and a lot of materials to build out their data centers. And that they're doing that, and they're pretty much burning a lot of cash. So that's also a risk item. It's like, whoa, will they ever make that money back? Well, they have a decent gross margin of 59%. Their operating margin is terrible, and their profit margin is positive, which I think is because they sold some Bitcoin or some other cryptocurrencies that they had on the balance sheet. You see their free cash flow margin is really, really bad. So looks like we have some Nebius investors in the community. Benton's an investor, great, and it's been a roller coaster, and so has Juicy's been an investor in Nebius. I don't think he's on the stream, but he's done really well with it. So the numbers just look they're difficult numbers to digest, right? Because these are really negative numbers. All right, so let's try to make sense of them. So when we let's look at their balance sheet. So right now they're sitting on this same amount as cash as they do debt. So it's not risky yet. Um, it will be risky soon. I mean, where are they getting the money to spend that kind of free cash flow? Um, they're probably they have to be going into some debt, but we'll see. We'll see. Eventually that'll show up. Okay. So how could I value this company? Let's take a look at their forecast. They're going to lose money for the next couple of years. See, they're not going to be profitable until like fiscal year 2028. So for the next 2 full years, they're going to be operating at a loss. They are going to be growing. They're going to be growing quite a bit, make themselves, they hope, a $7 billion revenue company. Just be aware that if we have, and I'm thinking that as soon as like 6 months from now, call it 7 months from now, and we're going to see the next round of earnings come out in late January, roughly a month from now. And those earnings will be really important. I'm not expecting a big like change in how much money these companies that need the data center, like AWS, Azure, Google Cloud, and other businesses that are investing or buying services from companies like Nebius. I don't think they're going to change their tone a whole lot in 1 quarter, but in 2 quarters they may. And here's my thinking is if they truly aren't going to need the services, they're going to start messaging that, and they will probably start saying it in the first after their first quarter of 2026. So in about 7 months time is when we're really going to see, is AI going to continue to flourish? The data center trade really going to continue to flourish, or will it see some volatility? We've already seen that Nebius, CoreWeave, and the NeoCloud stocks really sold off for the last couple months. It'll really sell off if the big buyers of cloud services start communicating that they just don't need it because it affects the outer years of this forecast. They say we don't need it. Well, what's Nebius going to say? Well, we got to 2.5 billion, but we're never going to get to 7, or we'll get to 7 in like 5 years. Well, that totally throws the valuation of the company out the window because everybody's based their valuations on they're going to be, I don't know, $20 billion business at some point. And if they're not going to get anywhere near 20 billion, it just throws the valuation out the window. So that'll be interesting to track. That's going to be a very interesting area. I'll continue to look at it and see what these guys are doing. But I can't put together a valuation because I don't have any numbers to work with. So I'm going to have to just delete my my model on Nebius. So Nebius has been a winner for some. Great. Congratulations. Glad you made a lot of money. Hive, it looks discounted. Maybe I'll look at that one in a little bit. Kind of look at Hive is also a NeoCloud. All right, so it looks like a bunch of new messages came into the chat. Let me catch up. So some betting. You want to look at ROST and Sobo. Got it. Okay. All right, on the list, Mark. So TGTX seems like a good small cap biotech. Let's take a look at it, see what's going on there. TGTX. Biotech has a really good list of a lot of companies that look good. Good growth. They're supposed to keep growing for 5 years, good profits, good cash flows, just really good looking stocks. So I'll take a look at TGTX, see if it's like the ones that I've been looking at. And betting NGD. What does NGD do? So Zealy, CMG, that's Chipotle, I believe. And then Cake. Yeah, we got time. So Chipotle, they have been under pressure. I wonder if the stock has gotten to a good place. I'm not a big investor in restaurants. It's just a tough business. They don't make a lot of money, and we'll see. We'll take a look at them. We'll see what we've got, and we've got. So Rose seems a little bit overpriced with an intrinsic value of 140. Okay, we'll see. So you also own BRT. Yeah, if you played the data center, I mean, you made a lot of money. It's just, you know, when we were looking at the data center investing story, it was a lot of investors thought, boy, that's kind of a little too much to expect the spend. But those investors, and I will admit, I was wrong. No, they did spend that much, which is risky for the businesses that are spending it. Meta, what really got sold off when they reported their numbers and said this is how much we're going to spend on capex. The stock sold off, and they kind of learned their lesson. They're not going to spend as much. So we'll see how stocks trade with the earnings that come out in a month, and then the earnings come out in 4 months. We'll see how stocks trade. That's really, we're going to see the data center, the AI trade really evolve quickly in 2026. And the one thing I would say is if you're going to invest in Nebius or NeoClouds and so forth, you got to put your running shoes on and leave them on. And what I mean by that is you have to keep track of these stocks. And if you see that the whole story's changed, I think a lot of investors are going to get out quickly. No need to tell you guys. You saw this stock sell off, what was it, 44%, just in a matter of a couple months. That's definitely going to happen again if the story changes to the negative. So leave your running shoes on, continue to analyze these stocks, and be ready to run out should the story really change. All right, so let's get into ROST. So Ross Stores. And Ross Stores is a discount retailer, P ratio 26. They've done well for 1 year, and they've really have risen nicely, going from $126 a share up to $182. Year to date, really good. Small dividend payer, fairly priced. They are growing. They're growing really, really well. Last quarter, they announced, which ended November 1st, which was their third quarter, they grew by 10.44%. It's pretty good growth. And when we look at their profitability and free cash flow, they have grown their cash flows. Their cash flows are nearing $2 billion, Gross margins, they're a retailer. They're a discount retailer, so not going to be big margins, but 32.5. Operating margin of 11. Profit margin of almost 10%. That's good. And then free cash flow of 9%. All right, so I think I have a valuation on these guys. And this one's recent. I think they're priced too high. I think it's a good business, but it's not like a business that's gonna just continue to compound its value. It's a retailer. They do discount retailing. A lot of competition. They're always gonna have to compete against TJ Maxx, against Kohl's, Costco, everybody that sells apparel and other products. So these guys, not a business that I'm crazy about because it has so much competition, has lower margins, and right now it's priced too high. The stock over the 5 years, it's done okay, up 55%, paid a small dividend, but you're looking at the stock when it's really doing well. I think that last quarter really they did themselves a favor by growing quickly by 10%. This one here would not be a buy for me. It'd actually be careful. Now, I did look at this stock like a month and a half ago. I think my comments were, this looks like a decent stock based on their performance. And I'll have to rewatch that video, but I think I was in the mood of, hey, it looks like a decent stock. I could understand an investor buying it. But right now it's bid up. The last 30 days have been a good 30-day period for Ross Stores. But for me right now, that would be a total pass. All right, so let's take a look at TGTX. And that's TG Therapeutics. I think Mark asked about this. This is a biotech company, $4.5 billion in market cap. Year to date, not doing all that hot. It hasn't been doing great for over the 5 year, and I wonder why they're not catching a whole lot of buyers. So their forward P is 21.4, the current year PE 11. They're really discounted according to analysts. What do these guys do? So TG Therapeutics, a commercial stage biopharmaceutical company, focuses on the acquisition, development, and commercialization of novel treatments for B-cell mediated diseases in the United States and internationally. It provides Briumvi, an anti-CD20 monoclonal antibody for treatment of adult patients with relapsing forms of multiple sclerosis. Okay. So they're going after some diseases, some pretty nasty ones. All right. And here's their pipeline. So they're in phase 3 with a couple of these treatments. And this one's been approved. Okay. All right. So looking at the financials, they went from being pre-revenue, pretty much pre-revenue, to revenue phase of their company. And looking at the quarterly, man, they're growing really fast. Okay. So the growth is really fast. I'm going to look at their forecast in a few minutes. They're not providing free cash flow yet. Their gross margins look great. And for some reason, they had a really high profit margin recently. Okay. Okay. So if a company got to profitability, I think it's investable. Analysts think there's a big discount available on these guys. So they're growing this year, they're growing really fast. This is the year we're in. And then next year, they are going to grow at nearly 50%. And then in 2027, 26.5, then 29.5. This looks really good. This growth is awesome. It's going to be profitable. P ratio is going to come down. This seems really discounted. Why is the market not liking it? This looks like a good opportunity. This is really good growth. They're going to expand their profits really nicely. P ratio is dropping to single digits eventually for a company that's growing really well with really high gross margins. Okay, so let me ask um, TG Therapeutics. Let me ask Gemini. So with biotech, we want to know when are patents going to expire? So it looks like the key patents are going to expire in 2042. So that's not a, big risk in the next 5 years. So we're good there. And then the pipeline's coming, and so they have some approved drugs. I mean, this stock looks really good. It has a lot there. Why is the market not buying it? Are there some negative stories? New competition. Is the competition real? Is it going to compete with them? I don't know if I'm going to get to this article, but let's take a look. Yeah, it's asking me for a bunch of stuff, so no thanks. So I'm asking Gemini for the competition. So they do have some pretty big companies like Roche, Genentech, Novartis, Sanofi. That's pretty big. Okay. And then Bristol Myers. So they do have some big competition. Nonetheless, this one most definitely, you should research this one. Get to the bottom of what is the competition and the threats. Are they real or are they not real? And this thing should really be a really good stock to work with. It's really going to go up in value because you're tapping into a company that has a very good forecast. They have very good patents. They have very good gross profits. I would do some digging here. So I think, Mark, you asked, I would really stay on top of this one and see if you can get to the conclusion of are the fears overdone or are the fears real? And if the fears are overdone of competition, you could probably see a great rate of return, because this stock has really good fundamentals. Looking at the 1 month, not doing great for the 1 month. I can't do a great valuation because they don't have cash flows. We can look at their earnings per share. And I agree. Usually I come in close to where analysts are going to be on the valuation based on earnings per share. So I'll probably get to a discount that's going to be near this just on earnings per share. So this is a good one. This is a good one, but you have to answer the question of, is the risk of competition real? Is it really going to disrupt their growth or not? So comment here from between here and there. They're too concentrated in one drug. That could be the case. Now, they do have the pipeline look like they were going to bring in some new drugs. Yeah, that could be it. That could be the story. And I guess the research that I would recommend is, well, is there the new drugs they're coming out with, is that going to help them diversify their revenues and make them stronger and better? So I think there's a lot there. It's worth taking a look. It's worth doing your homework. It may conclude that, yeah, it's a bad investment. But if it's not the case and the market has it wrong, it's an opportunity to make money. So good luck with that. Thanks for asking about TG Therapeutics. It looks like an interesting stock. All right, so let's take a look at Chipotle Mexican Grill. These guys not having a very good year. Now, for a while, this looked like a genius investment, but that's all in the rearview mirror. The 1 year, it's looking really bad, down 38%. Market cap 49.7. P ratio is still high, 32 for a restaurant's way too high. Restaurants should be selling at 12 to 18. These guys are priced too high. These guys are discounted according to analysts. They are growing. Interesting. They're growing by 14.6. The growth is slowing. That's what the market's freaking out about. Selling off the stock. This becomes a slow grower, then investors are not going to be all that excited. When we deal with restaurants, we're going to deal with smaller margins. Gross margin is 40%. Profit margin is good. Free cash flow is good. It's just a restaurant. It's very hard to grow. If you're going to grow, you have to put a lot of capital into new stores. You have competition, right? These guys are making burritos, but there's probably tens of thousands of restaurants that make burritos that are competing against Chipotle. So it's just a very competitive market. A lot of things can go wrong as well. You can have a bad incident with food not being, fresh and maybe making some people sick. But look at here. Let's see. This is the current year. They're slow growth. They're supposed to start growing again, but their P ratio is so darn high. I think it's going to take a while for Chipotle to become a really positive investment, where if this thing had a PE ratio in the forward year of like 18, then I might be interested. Like if we had a 15 being forecasted, okay, now we're talking. Just because there's very little margin opportunity, since it's got very low gross margins and it's a restaurant. It's not one of my favorite investments because so many things can go wrong with a restaurant. Okay, so Chipotle Mexican Grill. I don't know that I have a valuation on these guys. Yeah, I think they're 18% overpriced. They just don't create enough cash to match up to their stock price. They're currently, since they've had a big sell-off, based on earnings per share, using a PE of 24, which is not right. I would rather go 18. So these guys, it's just not. I don't want to play with a restaurant. No thanks. Too many things can go wrong. We talked about diversification earlier. As you diversify and create your portfolio, realize what kind of risk you're taking in the business you're buying, right? Like the last 15 years, 20 years, Chipotle on a couple of occasions, there was like food poisoning incidents and the stock got destroyed. More recently, they started to have slow growth. Stock got destroyed. I go into a Chipotle and I would say half the time the restaurants aren't that clean and it's food, right? So it's got to be clean. There's some really like, restaurants that are, quick serve, like In-N-Out Burger, they're always super clean. You go into some restaurants, they have an exceptional level of quality. Chipotle's falling off. Like you look at their burrito or burrito bowl or taco assembly area, sometimes it just looks so messy. I can't help but to point that out and say, these guys are going to get somebody sick along the way. Just doesn't look like the cleanest outfit I've ever eaten at. I don't eat there all that often. I have a lot of good choices for Mexican food in Southern California. All right, so that's Chipotle. Thanks for asking about that, Zeely. So let me check in on the chat. So I think I'm on top of things there. All right, so we're good there. So Sobo, Benton, you asked about SOBO. What is that? SOBO. South Bow Corporation operates as an energy infrastructure company. The company operates 4,900 kilometers of crude oil pipeline infrastructure connecting Alberta crude oil supplies to the U.S. refining markets in the U.S. Midwest and Gulf Coast. So these guys are a midstream player, and so they have the infrastructure to move the crude oil. A lot of crude's coming out of Canada. They have reserves up there. All right. So when you deal with these pipelines, sometimes you're buying a stock and it's you're buying into a partnership. So just be aware of that. So common stock. Okay. So this is common stock. It's not a partnership. And it's not a real estate investment trust. They pay a big dividend. That dividend looks good. When you buy into pipelines, one thing that you may be aware of is you're insulated from the price per barrel in that volatility. Like if you're a Chevron and the price per barrel goes down, your revenues go down. If it goes up, your revenues go up. Well, when you're the pipeline company, you're getting paid to transport that oil and you're getting paid a rate and you're not directly impacted by the price per barrel. So that is advantageous. It's more consistent. Over the 5-year, when these guys IPO'd recently, yeah, it looks that way. They IPO'd in 2024. So they've been around for a little over a year. And they've had a successful IPO. It's been out for a year. Looks good. Market cap 5.7 billion. Revenue 2 billion. That dividend looks really attractive. We'll see if they can afford it. Okay, forward P 16.89. Okay. So you see, we don't have a lot of history because he just IPO'd. They have had a couple of earnings announcements. Now, this doesn't look great because they've been kind of contracting. Maybe less oil is being put in that pipeline because oil prices have been depressed. They've been low. So maybe the revenues are beginning to come down. So that's a little bit of a concern. So 5 analysts cover it. They think it's discounted a little bit, and they have a forecast for 26, 27, 28. So no growth next year, some growth the year after. P ratio is going to be at 15. So this one here, I mean, that dividend, if you're an income investor, I can understand an income investor wanting to buy a stock like this, get 7% um, dividend. But I don't think this stock's going to appreciate much. Will it drop in price? Maybe. It won't drop a lot, but I think it could drop. But I don't think it's going to rise much more from here. I don't think investors want to pay a high PE ratio. When we compare that to a couple of other stocks, like if you go with a major company, you're buying in at a P ratio of 20.45. And this is like a really well known company, right? And then if you want to go into a smaller company, let's say, and I want to pick one that has midstream in it. Um, we go Oxy. This is 26 PE. But these guys, they make a lot of money once oil starts going up. These will never kind of accumulate a lot of value. They usually trade sideways. They usually kind of stick to the same valuation, and you don't see great appreciation. You just get that dividend. Speaking of which, the payout ratio right now is a little high. So will they have to cut back on the dividend? Maybe. They've only been around for 1 year publicly traded. Hopefully they don't cut the dividend. But if oil prices are really low and there's less volumes being pumped, they may not have a choice. They do have some debt, $5.78 billion of debt. That doesn't look good. Debt to EBITDA is 6.31. That doesn't look good. So this is a problem for me. These guys will not be able to create a bunch of cash to pay off this debt. This will always be kind of a weight on the stock. So I would not invest in this. I haven't had luck. I mean, it's been a long time since I invested in a pipeline. I invest in the majors and I invest in Oxy and EQT for natural gas. But I don't really play in the pipelines. I don't think there's enough upside for me. I want to double the value of my stock every 5 years or better. And these just don't fall into that pattern, and they never will. They're pipelines. Right. Let's go over to cake, which I think is Cheesecake Factory. Talk about another restaurant. And, there has been a big change in the types of restaurants that people are eating in, right? And we can think like the quality food that a lot of businesses are producing, like I mentioned In-N-Out Burger, and you have Chipotle, another example. But the whole quick serve is in, and it's really caught a lot of additional revenues because of DoorDash. And DoorDash has been a real good accelerator for these companies. Now, the Cheesecake Factory is kind of older school, kind of sit down restaurant. And for a while, this thing was not looking good coming out of COVID. But more recently, it really flourished. Why did it flourish so much? Low PE, discounted according to analysts, and it pays a dividend. It's had, coming out of COVID, and they had a big contraction. So then they were able to show big growth. They continue to grow. Quarterly, they continue to grow single digits. Now this one here, hopefully, yeah, here it is. Nope. I was hoping that they'd have some metrics on how many stores they're opening. Are they opening new restaurants? Okay, so trailing 12 months growth is 5%. Gross margins 40%. Net profit margin 4%. Free cash flow 4%. There's no way I can value this stock. It's a $159 million free cash flow stock. Yeah, I can't get to this valuation. I'd probably get to like maybe 1.8 billion, 2 billion, and then I'd have to decrement debt. And how much debt do they have? So, yeah, they have a fair amount of debt, 2 billion. Yeah, these are not businesses I want to be a part of. I want to see like Reddit. It just really takes off. It has a great future, high growth. These, right, is like it's a cheesecake factory. It's like it's a restaurant. It's not going to be worth much more in 5 years. It may actually be worth a lot less because the consumer's taste, the consumer's preferences change. It could really surprise us. We could be sitting on a pretty bad loser. So that one there, I may have a valuation for Cheesecake Factory because I know it's been asked about in the past. No, I don't have it. But yeah, I'm not a big fan of restaurants. They're just they have to do so much and they have low margins. I'd rather go with higher margin industries or industries that have just a really good catalyst for growth, like Amazon. We're going to keep buying stuff online and we're probably going to buy more stuff online in the years to come. So there's just going to naturally be more organic growth in the market. Restaurants, you just kind of constantly see new restaurants open that are adding to overall competition in that space. It just makes it harder to make money. I want it so that the business I own is going to flourish in the future. NGD. That is New Gold. So New Gold, an intermediate gold mining company, engages in the development and operation of mineral properties in Canada. It primarily explores for gold, silver, and copper deposits. So these have been doing great. 250. Ooh, beautiful. It's not going to be like this forever, right? Let's take a look at the forecast. And the compares keep getting difficult. And not too far in the future, it's going to start contracting. So be aware. You got to keep your running shoes on if you invest in a stock like this. If you see the price of gold beginning to drop, the forecast is the gold's going to drop. If these guys can't produce more gold from their mines and keep the growth in the business, will investors keep the shares? I don't think so because it's going to be a contracting business. It's going to be kind of like, hey, when are you going to start growing? Now, if gold prices keep going up, that's a different matter altogether. Yes, they could continue to flourish, but we got to start seeing a forecast that's green out 3 years. Right now, we have green for 1 year and then red. That's my worry. Got to leave your running shoes on and really keep up with a stock like this. I don't invest in gold miners. Never have. I do invest in Bitcoin, and that's about it. And my Bitcoin holdings are small. So New Gold flourishing. And I did a video on material stocks. I think right now it's just with members. And the ones that came up really strong were like Newmont and other gold producers. They are doing really well. But again, their forecasts show us that, hey, it's going to come to an end. And what's going to happen? How are investors going to like the stock once it stops growing? So that's where I'm at with New Gold. Interesting. Thanks for asking. All right. So I think I'm caught up there. All right, guys. So why don't we call it a stream at that on that note there. Thanks for joining, everybody. I'm going to be streaming tomorrow morning with Daryl. If you want to join us from 9 a.m. Eastern for a couple hours. And then I'm going to stream Tuesday in the early afternoon, early evening, and stream again with Daryl on Wednesday morning. So there'll be plenty of streams. If you'd like me to look at a stock, shoot me a Discord message, shoot me an email, go on one of my videos and give me a comment. And I'll be sure to add it to the list. And hopefully you can make it to one of my streams. Yogi, thank you very much for the comment. Appreciate it. Yeah, happy holidays. And appreciate the sentiment there. Michael Anthony, thanks for all the messages you put out there. Thank you, sir. Between here and there, thanks for the detail on TGTX that you provided. Benton, thanks for the stocks that you brought up. Zeely, great seeing you. Mark, good to see you. Good luck this week. And looks like Magical Self, good to see you. Mike, the dividend investor guy, great to see you. Herdo, thanks for tuning in. And again, thanks to the newest member of the channel. Thanks for signing up today. Really appreciate it. Please get me your details on when you can. I'll get you all the perks. Yeah, so really appreciate the comment. Thank you. I really try hard, and I'm glad that you're seeing some value in the content I'm producing and the research. I'm going to keep going deep on research, and I want to keep getting better at investing. I had a great year, but I want it to get even better. I want my performance to be even better. And I had breakfast with my wife and kind of put a goal for myself out there that's going to be hard to achieve, but really, really high goal that I'm going to try to achieve. And I'm only going to get there by getting better at finding true value in stocks, finding something that has a good valuation and consistently picking winners. Not, hey, I picked 1 out of 4 winners and that one winner was great, but then I had to own 3 dogs that I had to get rid of very quickly. No, it's more like I picked 3 out of 4 winners and I got rid of the dog as soon as possible. And then I can really compound the wealth in my portfolio that much quicker. That's what I'm trying to achieve. And I'm going to do it through research and analysis. And I'll keep sharing it with you guys. Keep sharing it with members first and then publicly 30 days, if not later after that. So that's it, guys. Thanks for tuning in. Really appreciate it. Enjoy the rest of your weekend. Have a terrific week. Happy holidays. Let's do our homework so we can hit the ground running for 2026 and outperform the market and beat those institutional investors while we're at it. Take care, everyone.